Welcome to the BDO Tax Support for Professionals webinar programme. My name is Nigel Giles, and today I will be your guide through the key legislation, tax planning, pitfalls and practicalities of income tax loss reliefs. This presentation was recorded on the 6th of May 2020 and is based on the law and practice as of that date. If you have any queries or observations on the material contained in this webinar, please do not hesitate to email or telephone either myself or any of my colleagues whose contact details are on the final page of this slide pack. Before we dive into the material, I'd like to say a brief word about BDO Tax Support for Professionals. We've been providing proactive tax advice to accountants, lawyers and in-house tax teams for over 30 years. We are all professional tax advisors and know that sometimes you just want to clarify or confirm your thinking, or even perhaps sometimes just need to reach out for help. This is when the Taxline telephone helpline is there for you. For larger projects, we are able to help you scope out the work required and to assist as much or as little as you require, including providing formal written advice. We are able to provide an upfront quote so that there is no surprises. If you'd like to find out more about us, please visit our website at www.bdo.co.uk/TSP, where you can also sign up to our free weekly newsletter. Alternatively, just call us on either 0845 356 0006 or 020 7893 3266. We're here to help. And now, without further ado, let's get into the webinar. We will start with trade loss reliefs, which will be the primary focus of this presentation, although I will speak briefly later about property losses and other losses. I think most practitioners are familiar with the main loss reliefs for continuing trades. These are sideways loss relief under Section 64 of the Income Tax Act 2007, which is an offset against general income in the current tax year or against general income of the previous tax year. It's an all or nothing claim. If a claim is made for a given tax year, the losses must be utilised as far as possible against the general income for that year before any balance can be utilised by other claims, even if that means, for example, that personal allowances are wasted. The time limit for a claim is 12 months from the filing date of the tax return for the year in which the loss arises. Section 71 of the Income Tax Act 2007 and Section 261B, Capital Gains Tax Act 1992, extend the sideways claim to capital gains arising in the same year as the trading loss. But importantly, Section 71 losses can only be claimed after a Section 64 claim for the year in question has been made. The time limit is the same as for Section 64 claims. The default position, in the absence of sideways loss claims, is that unused trading losses are carried forward to offset against future profits of the same trade as they arise. It's important to note that a claim is still required. The time limit of the claim is 4 years from the end of the tax year in which the loss arose. One additional note on this slide, in 2008-9 and 2009-10, there was a temporary extension of the sideways reliefs to allow an offset of losses against trading income only for the 3 preceding tax years. It will be no surprise if similar measures are introduced at some point for the current year. On this slide, we are concerned with loss reliefs at commencement and cessation of the trading business. Section 72 of the Income Tax Act 2007 concerns losses in the opening years of trade. The relief is generous. It applies to losses in the tax year in which the trade commences and also to losses that arise for the next 3 tax years. Losses arising can be offset against general income of the 3 preceding years, starting with the earliest year first. As with sideways loss claims, partial claims are not possible. The time limit for a claim is 12 months from the filing date of the tax return for the year in which the loss arises. Relief under Section 89 of the Income Tax Act 2007, also known as terminal loss relief, applies on cessation of the business and is more restrictive in that relief is only available to offset against trading income of the 3 previous years, on a last in, first out basis in this case. It is also a more difficult relief to apply in practice in that the calculation of the terminal loss is not always straightforward. We will discuss this in more detail on the next slide. Terminal loss claims can be made at any time in the 4 years after the end of the tax year in which the business ceases to trade. Thirdly, there is a very specific loss relief under Section 86 of the Income Tax Act 2007, which gives relief to unutilised losses of a sole trader or of a partner in a trading partnership at incorporation of the business. Section 86 applies where 1. A business that was carried on by an individual or by a partnership has been transferred to a company. 2. The consideration for the transfer was solely or mainly an allotment of shares in the company to the individual or the partners concerned. And 3, the total income of the individual or the partners for a relevant tax year includes any income derived from the company, whether by way of dividends on those shares or otherwise. Section 86 allows the individual concerned to claim otherwise unclaimed losses against their future income from the successor company, not confined to dividends but also remuneration and other income sources, until the losses are exhausted. The time limit for a claim is 4 years from the end of the tax year in which the claim is made. Returning to the terminal loss claim, this slide gives an example of how the terminal loss available for relief is calculated. The start point is to identify the terminal loss period. This is the 12-month period immediately prior to cessation. In practice, as illustrated in this example, the final 12 months will often not neatly coincide with a 12-month accounting period, and it will be necessary to factor in the relevant portion of the profit or loss from the penultimate accounting period into the terminal loss calculation. In this example, which we have taken from the HMRC manuals, there are 3 components to the terminal loss calculation. These are, firstly, the loss of the final accounting period. In this case, the loss involved is £9,000. Secondly, the relevant portion of the profit or loss from the previous accounting period, which falls within the final 12-month period. In this example, there is a profit of £12,000 in the previous accounting year, of which £3,000 falls within the final 12-month period of trading. Finally, the unused overlap relief. In this case, the overlap relief is £2,500. If there is unused overlap relief, which hopefully has been reported each year on the annual tax return, this will automatically be factored into the terminal loss calculation. In this case, the total loss available for terminal loss relief is £8,500. There is an unused balance of loss from the final accounting period of £3,000, which cannot be utilised by the terminal loss claim. That said, another loss claim, a sideways claim under Section 64, say, might be available to utilise this loss instead. Identifying the date of cessation of a business isn't always obvious. I've certainly seen situations before where sole trader businesses have run down as business proprietors have drifted into semi-retirement, and where there is no obvious cut-off point for the cessation of trade. It is not unusual for there to be continuing obligations at cessation of the business. Ideally, such potential costs should be provided for in the final accounts, and appropriate relief claimed in the calculation of the trading profits at cessation. In practice, however, it is not always possible to fully provide for the known unknown costs at cessation, let alone the unknown costs that can apply to even the best ordered businesses. The rule of thumb is that post-cessation expenditure is potentially relievable if it meets the wholly and exclusively test that would apply if the business was continuing to trade. Typical examples of costs that might apply include claims in respect of defective goods, professional indemnity insurance, debt collection costs. Post-cessation expenses must be offset against any post-cessation receipts of the same business arising in the same tax year before any other relief can be considered. Any excess payments which fall within the specified categories of Section 97 of the Income Tax Act 2007 and take place within 7 years of the cessation of the trade may qualify for relief against, firstly, general income arising in the same tax year as the expense was incurred, and secondly, if there is any excess, against capital gains arising in the same year. Claims for relief must be made by the first anniversary of the filing date for the tax year in which the payment was made. Absent the claim for relief, or if there is an excess loss, the only remaining avenue for relief would be against future post-cessation receipts from the same source. It's now time to look at situations where trading loss reliefs are restricted. The cap on certain income tax reliefs, introduced from April 2013, is now a familiar, if unwelcome, part of the personal tax landscape. To recap, the restriction operates to limit the amount of relief that can be claimed in any given tax year to either £50,000 or, if higher, 25% of the taxpayer's adjusted total income for the tax year. The cap applies to the list of reliefs specified at Section 24A of the Income Tax Act 2007. These include claims for sideways loss relief under Section 64, early years loss relief under Section 72, and post-cessation expense claims. Importantly, the restriction does not apply to loss claims where the loss is offset against profits from the same trade. Terminal loss claims fall into this category. Additionally, Section 64 or Section 72 claims where the loss is offset against income from the same trade would not be restricted. Overlap relief is not covered by the cap on the basis that overlap profits are by definition profits that were taxed twice previously. Finally, reliefs against capital gains are not included within the restriction, and therefore claims under Section 71 can be made without the 50,000 cap applying. Moving on to other restrictions. It is important to be clear that the trade in question is operating in circumstances where the business is being conducted on a commercial basis and with a reasonable expectation of profit. Sideways loss reliefs are not available for less commercial activities, for example those which are more akin to a hobby than a trade. An additional provision applies to prevent sideways loss claims in farming and market gardening businesses where there have been losses in a sixth continuous year. As noted on the slide, there is an anti-avoidance rule excluding capital allowances on assets provided for leasing from sideways loss claims in the circumstances outlined. On this slide, I'd like to highlight an unexpected consequence of the £1,000 trading and miscellaneous income allowance that was introduced in 2017. The way the legislation works is that where an individual's relevant income for the tax year does not exceed the £1,000 trading allowance, there is no charge to tax. This means that the receipts themselves are not brought into account as trading income, and there is no tax relief for expenses that would otherwise have been deductible from these receipts in computing the trading profit. The profits or losses of the trade would simply be treated as nil. That said, the individual can elect for the allowance not to be given and instead make a claim for the full expenditure incurred, which they would clearly wish to do if the business is in a loss-making position. The point to be aware of is that the election to disapply the trading allowance must be made first in order that the loss claim can then be made. As noted on the slide, the strict due date for the election is no later than the first anniversary of the 31st of January following the tax year in question, which is a shorter timescale than the 4-year time limit to claim trading losses. That said, HMRC have indicated in their manuals that they would accept a late election that falls within the 4-year time limit for making loss claims. One last miscellaneous point on trading losses concerns Class 4 NIC. The rules for the application of trading losses in the Class 4 NIC calculation are complex and do not automatically follow the income tax rules. In particular, they would diverge where a sideways loss claim is made to relieve trading losses against general income. The loss for Class 4 NIC purposes in that situation would be preserved and remain available to offset against future trading profits instead. Just to wrap up on trading losses, there are a number of practical points to think about in a situation where there is a trading loss. Firstly, obviously having an awareness of all the options available is key. Sometimes the most obvious answer isn't the most tax efficient one. For example, a terminal loss claim will reduce trading income profit for up to 3 preceding years, which in some circumstances will give a better result than making a sideways claim against general income, which is restricted to the current year and or the preceding year. In some circumstances, the opposite may be the case. As a more general point, what is the best way to access relief at the highest possible rates, and are there any ways to avoid the wastage of personal allowances, for example? My second point is to look out for unexpected tax results. Take the cap on loss release, for example. If a loss claim or claims for a given tax year exceeds the cap for that year, it may be possible to use the excess losses for a claim against another year. In effect, a limited form of partial loss relief may become available. As a result, a taxpayer with substantial trading losses and substantial other income may be able to generate tax relief in multiple years without wasting personal allowances or at a better tax rate. Thirdly, think both short-term and long-term. Claiming a sideways loss is often preferable because of the benefit of having the tax relief now rather than later. But what are the long-term prospects of the business? In a business where rapid growth is expected, carrying forward the losses may give a better result. This is a point that the client should be made aware of when you're considering the claim. Fourth and finally, are there any other impacts of claiming the losses? For example, the EIS CGT exemption can be an extremely valuable relief, which relies on at least part of the EIS income tax credit being claimed. The CGT exemption will be lost if a subsequent loss claim is made for the year of the EIS claim, which eliminates the tax liability for the year. Similarly, gift aid donations rely on there being a sufficient tax liability to credit the basic rate tax reclaimed by the charity. If there is no tax to pay in the same year as a large gift aid donation, an unexpected tax charge may arise on the donor as a result. As a practical point, you will often find that sitting down and doing the number crunch of the options available before making final decisions on losses is time well spent. Partnership losses. Partnership losses are calculated in the same way as partnership profits. The overall tax-adjusted profit or loss for the partnership is calculated, and then each partner is allocated their share of the loss in accordance with the terms of the partnership agreement. If the partnership agreement is silent on the subject of losses, the usual practice is that the losses would follow the profit-sharing ratios. Each individual partner will then make their own claims for loss relief on their personal tax return. The loss relief discussed previously would be available for each individual partner to claim as appropriate. It is possible that under the terms of the partnership agreement, one partner may make a profit and another partner a loss for the same tax year, for example, where it is agreed that a partner will receive a fixed sum as part of their profit share. In that situation, the losses available for relief are restricted. In effect, the loss-making partner has to offset his loss against the profit-making partner's profit share. One result of this is that it is not possible for an individual partner to make a loss claim where the partnership as a whole has made a profit for the same period. Sometimes the partnership agreement may give some flexibility in terms of how to allocate the losses, but as you will appreciate, it is not possible to make retrospective changes to the agreement. Claims in respect of allowable expenditure that has been personally incurred by partners can only be made through the partnership tax return. It is not possible to claim these on personal tax returns. The other big point to make about partnership losses is to be aware of the sometimes quite complex restrictions that apply to sideways loss claims, which are specific to partnership losses. As noted on the slide, these restrictions apply only to trading partnerships. They do not apply to professional partnerships. Non-active partners, essentially partners who spend less than 10 hours per week engaged in the trading activity of the partnership. For the first 4 years of trade, they can claim sideways loss relief, but it is restricted to the lower of £25,000 or their capital contribution, minus any previous sideways loss claims. From the 5th year, only the £25,000 cap applies. Limited partners. Relief is also restricted where a partner has only limited exposure to the debts of the partnership. The annual sideways loss claim is restricted to the lower of £25,000 or the capital contribution, minus any sideways loss claims. This is a permanent restriction, so the total sideways loss claims can never exceed the capital contribution. LLP members. For similar reasons, sideways loss relief is also restricted for members of an LLP. The annual sideways loss relief is restricted to the lower of £25,000 or the capital contribution, minus any sideways loss claims. Again, this is a permanent restriction, although losses can, of course, be carried forward to offset against future trading profits. We now move on to property losses. Loss relief on income from property is much more restrictive than relief on trading losses. Losses of a given tax year, as a general rule, are automatically carried forward to offset against future profits of the same property business. The exceptions to this general rule are whether losses result from either a capital allowances connection or a relevant agricultural connection. Where applicable, the losses can be offset sideways against general income, subject to the cap on loss reliefs mentioned earlier. Both situations are rarely encountered in practice, and I have not discussed them further here. When considering property losses, the start point is to appreciate that all UK rented properties are treated for tax purposes as forming a single combined property business. If there are losses on some properties but profits on other properties, the losses are automatically offset against the profits to produce a single combined result for the year. If there is a surplus, it is taxed. If there is a loss, it is carried forward to offset against future profits of the same property business. There are specific rules and restrictions concerning furnished holiday lettings losses, which we will discuss in a minute, and restrictions on the losses available on properties let out at below the market rate. But the overarching principle is that all UK rented properties are all part of a single UK property business. If the taxpayer owns property overseas, this will form part of a separate overseas property business. Losses from the overseas property business can be offset against future profits of the overseas property business, but cannot be offset against profits of the UK property business. Similarly, losses of the UK property business cannot be offset against profits of the overseas property business. Where properties are held in partnership, each partner is treated as having an interest in a separate partnership property business. Losses from the partnership property business can only be offset against future profits of the same partnership property business. They cannot be offset against profits of a UK property business. They cannot be offset against the profits of an overseas property business, and they cannot be offset against the profits of another partnership property business. A UK furnished holiday letting is part of a UK property business, but because of the rules that deem the FHL to be a trade, furnished holiday lets have their own loss provisions. Historically, these losses were very generous, allowing sideways relief against other income, but since 2011, relief for FHL losses is actually more restrictive than for general property losses. As the rules currently stand, losses from a UK FHL business cannot be offset against profits of the other properties in the UK property business. They can only be carried forward to offset against future profits of the UK FHL business. Losses of the other properties in the UK property business, on the other hand, can be offset against profits of the FHL business, as this is part of the calculation of the UK property business's profit or loss for the year. FHLs located in the EEA form part of the overseas rental business, and similar considerations apply in respect of the offset of losses. One final point on this slide: you will probably be familiar with the excess interest tax reducer on finance costs on loans to acquire rented residential properties, which is now a factor in the annual tax calculation. There are provisions which enable the unclaimed interest relief to be carried forward for future offset where there is a rental loss for the year. We discussed earlier the unexpected consequence of the £1,000 trading and miscellaneous income allowance that was introduced in 2017. Similar considerations apply to the £1,000 property allowance that was introduced at the same time. If the rental income for a given year is less than £1,000 and there are property losses to offset against future years, it will be necessary to elect not to receive the property income allowance to unlock the losses for future relief. The strict due date for the election is no later than the first anniversary of the 31st of January following the tax year in question, but again HMRC have indicated in their manuals that they would accept a late claim, providing it falls within the general 4-year time limit for making loss claims. This slide discusses relief on losses arising from miscellaneous transactions. For example, this could include activities that fall short of actual trading, but where HMRC would consider that any surpluses would be taxable under the sweep-up provisions for miscellaneous income. Broadly, if the activity is undertaken with a possibility of profit, then any losses can be carried forward and offset against future profits from the same activity. Additionally, there is the list of other items that fall within the scope of the miscellaneous income provisions for which losses can be offset, which is in the HMRC manuals at the reference quoted on the slide. In each case, losses arising can be carried forward and offset against future profits of the same activity. This concludes the session, which I hope you have found useful. If there are questions, contact details for myself and for the tax line generally are set out in this slide, and we will of course be happy to assist. This final slide gives the contact details for myself and for my colleagues in the tax line team. Thank you for listening.